Hey, what's up, everybody? Tim Albrecht here, and welcome to this week's episode of the Ask a YFP CFP segment of the Your Financial Pharmacist Podcast, where we feature questions from you, the YFP community, to be answered by one of our very own fee-only certified financial planners. Please note this podcast is intended for educational purposes and should not be considered financial or investment advice, as we do not know all the variables to one's personal situation when answering a question. Before we jump into today's question, a shout out to our extraordinary YFP financial planning team that makes this segment possible. Your Financial Pharmacist offers fee-only comprehensive financial planning services that are customized to the pharmacy professional. So whether you want to pay off your student loans, make the right investment decisions, or simply build a solid financial plan, we'll help get your income working for you rather than the other way around. You can learn more by visiting yfpplanning.com. Again, that's yfpplanning.com. This week's question comes from Danielle in Newnan, Georgia.
Hey YFP team, this is Danielle from Newnan, Georgia, just south of Atlanta, and I was wondering which mortgage term is best. Is it better to get a 15-year mortgage with a lower interest rate and knock the debt out as soon as possible, or get a 30-year mortgage and make extra payments but have that cushion of a lower monthly bill in case something pops up? Thanks, guys.
Tim Baker, another great question. What are your thoughts?
Yeah, so obviously one of the biggest purchases you'll ever make, at one time, I should say, with the home purchase, it is a big decision, and of course I'm going to give my traditional answer of it really depends. It really depends on what we're trying to achieve with the financial plan. Yeah. I'll give a few kind of food for thought here. Is I think when people are purchasing a home, I would say that 90% of people will kind of revert to the 30-year fixed mortgage. And I think a lot of that is, it's kind of like, okay, what's it going to cost me from a per month basis? And we like the lesser dollar amount, which means that we can potentially afford more home. But obviously the trade-off is that, you're just paying, anytime that you have large amounts of debt over long periods of time, whether it's a home, mortgage, a student loan, that's ultimately going to be a drain on the net worth because of the interest that you're paying over time. So I think, we talk about this with PMI a little bit with clients is like, and I had this conversation with a client. They're like, yeah, Tim, you're probably going to be upset with me, but I'm going to be, I'm going to purchase the house. I'm not going to have the 20% down. And, so I think I need to pay PMI. Mm-hmm. And I kind of I was a little taken aback by that comment because I think a lot of the gurus and people say, hey, best practice is 20%. And I'm like, at the end of the day, I'm not this is your financial plan. And, obviously we want, what's in your best interest and everything like that. And sometimes in your best interest is to get into the home and, have your family and things like that. So not to apologize for that. And obviously we have tools and, financing, with our, our relationship with Iberia Bank, which you can get a very attractive rates and avoid PMI all at the same time. So there's kind of ways around that. So in my experience is that when people first time home buyers, they're not putting that 20% down. It's something like 7 to 10% of people do. So they do wind up paying PMI, or they try to figure a way around that. So similarly, I think a lot of people start with the 30-year and then kind of reassess it maybe later on down the road, and look at a 15-year rate. Now, I'm going to steal a stat from Investopedia, and they say that, if you buy, so the math on this is if you buy a $300,000 home and you finance $300,000 at a 4%. So this is a 4% 30-year, which rates are a little bit lower than that. Yeah. Versus a 3.25% at 15-year. The 15-year, you're going to pay $79,441 in interest over those 15 years, compared to $215,609 over 30 years. So significantly more interest over that period of time. So you mortgage $300,000, you're paying more than $500,000 over the course of that loan. So I think the way that the way that you look at it obviously is what are the competing priorities? What else are you trying to do in the financial plan? So to me, the reason I say it depends is, one, we got to get a kind of a snapshot of where you're at, which is looking at the balance sheet and all the things that you have going on financially. And then secondarily, we have to kind of sit down and say, okay, where do we want to take this thing? A snapshot of where you want to go. And to me, until I have those two kind of pieces in place, my answer 95 out of 100 times is going to be depends. So then it's the same is true with this. So, what are the other competing priorities? Do we need to focus more on retirement? Is there other debt that's, kind of more on fire, so to speak?
Yeah.
Is there real estate that you want to do? Are you trying to, start a business? So what are the things on cash flow? Are you trying to put kids through college? So, that's the thought there. And the way that I look at this is, I kind of look at it, how old am I? I'm 37 right now. So like if I retire at 67 or 70, like for me personally, I just want, as I'm leading up to retirement, I just don't, I don't want a mortgage in retirement. So I want to be free and clear then. And I think if the rates make sense, like right now, the rates are, in the basement, you can make an argument that, we had clients with Iberia that put 3% down, no PMI, and at a 3% interest rate. And I'm like, wow, I mean, that's fantastic. I don't even know if I would want to be aggressive with paying that down. So the way that I look at it is what my wife and I are doing. We pay an extra, we have a 30-year mortgage. We pay an extra payment. So the way that works is if our mortgage is $1,200, which I wish it was, it's not. If it was $1,200, you divide that by 12, that's an extra $100 per month. And the math typically shows that shaves about 7 years off a 30-year mortgage. So that's one way that I kind of make myself a little bit, feel a little bit better. And then what I'm trying to, kind of back into is just not having that mortgage when I go to retire. So for me, I think similar to you, Tim, is like, I want to look at, different, businesses, real estate, different things for the cash. And obviously we're saving for the kids, education and our retirement and things like that. So I don't necessarily feel this overwhelming, need to have the debt paid off, but I do have some clients that we no debt, even the non-mortgage debt, they don't want it. And last point, we talk about, help pharmacists achieve financial freedom, and that's going to be different for everyone. But I think if you take the temperature of the room and most people, for a lot of people, it's, hey, I want to be free and clear of the student loans. That's kind of mile marker one. Mile marker two, or milestone two, I should say, is I want to basically be free and clear on the house. So I don't want to owe the bank any money there. And then lastly, it's I want to have enough cash money saved so I never have to work again. So, two of those things are really kind of focused on debt. And for a lot of people, it's like, hey, paying down the mortgage, and I think that's important when we kind of look at it in the context of financial freedom and what people are trying to achieve. But obviously a lot of moving pieces here with regard to the overall financial plan.
And this is why I love this question from Danielle, because this question should never be answered in a silo, and it so often is, right? And this to me just reminds me of the value of the comprehensive nature of planning, and whether you're talking, here a home buying decision or a refinance or it's student loans or your investment, they all impact one another. I've probably said that 20 times on the show at this point, but I'm living this right now, and I feel like I'm having this debate with myself every day. Like we're getting ready to actually close tomorrow on a refinance and 3%, 30-year, and I've been going back and forth. I'm like, if you look at the actual savings on a 15-year, that'd be great. Love to have it gone in 15, but I could take that extra money and make extra payments. Will I actually do that? Will other expenses creep in? But also, I think with any financial decision, you want to weigh, as we talk about all the time, you want to weigh how you feel about those situations with also the numbers. So, with every financial decision you make, there's an opportunity cost, and you have to evaluate that and, combine that with the rest of your plan, combine that with how you and or your spouse, if that's applicable, how you feel about that, and then come to that decision, or perhaps work with a coach that can help you do that. But just as you had mentioned, Jess and I have some goals around real estate and business and other things. And so making extra payments, would love to get rid of the mortgage, but also does that delay some of those other things? And is there a right answer? What is the right answer? I don't know, but I think it's a great reminder for Danielle, for us, for the rest of the community, of making sure that anytime you're making these big financial decisions, you're taking a step back and saying, okay, how does this fit along with everything else that's the rest of the financial plan?
Yeah. And it does go back to the behavior. Like you said, it's like, sometimes we say with the student loans, can a 10-year make sense, but, can we squeeze it into a 7? Because a lot of people say, well, I'll do a 10-year and then I'll add. And sometimes when you give yourself rope, you take it, right. And you don't, you buy, other things that don't necessarily, are important to the, the goals of the financial plan. So you weigh that. But I had a conversation with a client, yesterday, Tim, and it wasn't necessarily about home purchase, but it was about, PSLF strategy. She has a lot of federal loans, but then a small private loan, which is like, I don't know, she had like 12,500, and she's in a 5-year. She's like, I'm paying the 5-year, the payment amount, but I just feel like, I'm not being aggressive with that. I know I'm putting 10% into my 401k, and I know that, I have to optimize that. I should be maxing that out. And I'm like, well, how do you feel about the loans? She's like, they annoy me. And I'm like, pay them all, be more aggressive. And then we'll take that extra payment, and then we'll up the 401k allocation. And she's like, oh, well, she was a little surprised. She's like, well, like, the math. And I'm like, I basically said, like, forget the math. Like it's this is incremental. And I know her in particular. I know the way, she thinks and some of her goals. I'm like, just pay it off. And I told her, I'm like, for me, that would probably annoy me too. And it won't take that long. Just do it, and then we'll move on from there. So it does. It goes back to, like, how you feel and that. And I think that plays a big role. And sometimes, again, working with a financial planner, it's just kind of give the permission to be like, yeah, it's okay. It doesn't necessarily have to be all about the math all the time.
Well, and even just to have that conversation about, are we thinking about these other variables? And I think, so often, I felt with Jess and I with working with you, like the value so much is in you asking the questions that get us thinking, right? In a broader way, take us out of the silo and thinking about that one issue. So for those that are listening, are thinking, perhaps mortgage refinance does make sense given the current market of rates. We've got some great information available on the website. If you go to yourfinancialpharmacist.com/mortgage-refinance, again, yourfinancialpharmacist.com/mortgage-refinance. You can learn more there about the refinance process, as well as to begin that process of gathering rates. So again, thank you to Danielle for taking time to submit the question that was featured on this week's Ask a YFP CFP segment of the Your Financial Pharmacist podcast. And as a small thank you to Danielle, we're going to be sending her a super comfy YFP t-shirt. And for those listening that would like to have a question featured on a future episode, please head on over to yourfinancialpharmacist.com/askyfp or shoot us an email at info@yourfinancialpharmacist.com. Have a great rest of your day.